The committee. Thank you. The Committee of Insurance and Financial Services shall come to order. Mr. Clerk, will you please call the roll to establish a quorum?
Chairperson Carter.
Present.
Representatives McFall.
Here.
Coleman. Here. Stone.
Here.
Breen.
Present.
Rogers.
Here.
Scott.
Present.
Young.
Here.
Fitzgerald.
Here.
Grant.
Present.
Harris.
Here.
Markkinen.
Here.
Bazat.
Present.
Aragona.
Here.
Brooke.
Present remote.
Nyer.
Here.
Smith. Madam Chair, you have a quorum.
Thank you. We need a motion to adopt the minutes of April 13th, 2023 as printed. Representative Rogers moved to adopt the minutes as printed. Hearing no objection, the minutes are adopted as printed. First up today is House Bill 4376. Before everyone is the substitute H1. Here to explain the substitute is Joseph Sullivan from DIFS. Thank you, Joseph.
Good morning. It's good to see everyone again. So the sub before us today just reflects some of the feedback that we had received from the chair, stakeholders, and LSB throughout the drafting process. Although it's mostly technical changes, I can go ahead and highlight a few items. So some of the language was reorganized in a way that made a little bit more sense. So we moved the language, for example, allowing an agent to use their own funds to establish an account or pay bank fees. This was from subsection 4 in the introduced version. We moved that down to subsection 2 and streamlined that language a little bit to make it more concise and read a little bit better. And then also, rather than requiring a specified accounting standard or using a generic term like standard accounting practices or reasonable accounting methods, we just added more practical language in this version. We actually modeled this language after Idaho's language for their producer trust accounts statute. So the language now reads that any of the agent's own money deposited into the separate account under this subsection must be accounted for and identifiable in the agent's books or records. So rather than holding them to any specific professional accounting standard, which they may or may not be experts on, we just decided to streamline this language and make it a little bit more practical. So that's really it. Pretty simple changes, and we're comfortable with the version that's before you today, and of course, we support it.
Thank you, Mr. Sullivan. Now we need a motion to adopt the H1 substitute for House Bill 4376. Representative Fitzgerald moves to adopt the substitute. Mr. Clerk, would you call the roll?
Motion to adopt H1. Representative Carter.
Yes.
McFall.
Yes.
Coleman.
Yes.
Stone.
Yes.
Breen.
Aye.
Rogers.
Yes.
Scott.
Yes.
Young.
Yes.
Fitzgerald.
Yes.
Grant.
Yes.
Harris.
Yes.
Markkinen.
Yes.
Smith.
Yes.
Aragona.
Yes.
Brooke. Nyer.
Yes.
Madam Chair, you have 15 yeas, 0 nays, 0 passes. The motion prevails.
Yes.
Representative Bazat.
Yep. Yes.
You have 16 yeas, 0 nays, 0 passes. The motion prevails.
Thank you. The substitute is adopted. I have several cards of support that I'd like to read in. Rob Anderson from Farm Bureau supports the bill. Chuck May of the National Association of Insurance and Financial Advisors, Michigan, supports the bill. Marcia Hune, Life Insurance Association of Michigan, supports the bill. And Alex Hausman of the Big I supports the bill. Now we need a motion to report House Bill 4376 as substitute H1 with recommendation. Let me see. Rep Fitzgerald again, he's got it. Okay, Rep Fitzgerald moved to report. Mr. Clerk, would you please call the roll?
Chair Carter.
Yes.
Rep McFall.
Yes.
Representative Coleman.
Yes.
Stone.
Yes.
Breen.
Aye.
Rogers.
Yes.
Scott.
Yes.
Young.
Yes.
Fitzgerald.
Yes.
Grant.
Yes.
Harris.
Yes.
Markkinen,
Yes.
Smith,
Yes.
Aragona,
Yes.
Brock, Nair,
Yes.
Bazat.
Yes.
Madam Chair, you have 16 yeas, 0 nays, 0 passes. The motion prevails.
Thank you. House Bill 4376 is reported with recommendation as substitute H1. Next on the agenda is a referral of House Bill 4377 to the Committee on Tax Policy. Representative Stone moves to refer the bill to 4377 to the Committee on Tax Policy. Mr. Clerk, please call the roll.
Motion to refer bill to tax policy. Representative Carter,
Yes.
McFall,
Yes.
Coleman,
Yes.
Stone,
Yes.
Breen,
Aye.
Rogers,
Yes.
Scott,
Yes.
Young, Fitzgerald,
Yes.
Grant,
Yes.
Harris,
Yes.
Markkinen,
Yes.
Smith,
Yes.
Aragona,
Yes.
Brock, Nair,
Yes.
and Bazat.
Yes.
Madam Chair, it passes.
Thank you. House Bill 4377 is referred to the Committee on Tax Policy. The last item on our agenda is a presentation from the Institute's Griffith Foundation. Here today are Frank Tomasello, JD, an executive director of the Institute Griffith Foundation, and Dr. Robert W. Klein, Emeritus Professor of Risk Management and Insurance with Georgia State University and an affiliate senior research fellow with Temple University. We'd like to thank you for coming. Are you up? Come on. The floor is yours. And thank you so much for coming. Oh, we're honored. Thank you.
Good morning, and thank you, Madam Chair and members of the committee. I'm Frank Tomasello. Alongside me, Dr. Robert Klein. It's our pleasure to be here this morning. Madam Chair, we understand and appreciate that time is of the essence. As we understand it, we have about 60 minutes or so to speak with you today. Is that correct?
Yes, somewhere around there.
Understood. Thank you so much. I'd like to start very briefly with a few comments about the Institute's Griffith Foundation. First, to chat a little bit about our mission. The Griffith Foundation is a 501c3, a nonprofit organization. We are nonpartisan and non-advocative. And our mission, as you'll see before you, is to empower public policymakers and staffers. We do that through a greater understanding of insurance and risk management principles. We do that by providing unbiased educational programming. The rationale that sort of informs Griffith is fairly straightforward. Risk management and insurance play a very important role, a critical role in the security of our country, our professional endeavors, our personal lives as individuals. And we believe that informed risk management is a catalyst for a more secure future for all. Better informed public policymakers, we believe, are better equipped to make sound policy decisions. What we do at the Griffith Foundation, and I would encourage those who've not had a look to please feel free to do so, is we deliver both live programming via webinar. We have on-demand content available, and also in-person sessions like this that are put together and delivered to both lawmakers and the regulatory community on both the fundamentals of insurance and from time to time on emerging issues in insurance as well. Our content is complimentary. It is there for you all without charge. We would invite you to visit www.griffithfoundation.org. You can learn about programming there. A number of our programs are archived at that website as well for on-demand playback. You'll find lecture-type presentations there. You'll also find from time to time panel discussions as well. So we would invite you to have a peek. And a final comment before I turn things over to Dr. Klein this morning. Because of our mission, I want to be clear that comments today, contributions to today's session are purely instructional in nature. We're not here to take a position on pressing issues. Rather, our intent today is to provide foundational knowledge on both insurance and risk management more broadly, to equip you all as you wrestle with a number of very important and in many cases hotly contested issues here in the state of Michigan. Knowledge is power. Let's give you that foundational knowledge that will help you as you grapple with decisions for the benefit of those that you serve. With that, I will turn things over to our friend and colleague, Dr. Klein.
All right. Thank you, Frank. Good morning, Madam Chair and members of the committee. I really appreciate the opportunity to be here today to talk to you about risk management and insurance. And just in the interest of full disclosure, I'm a registered Democrat, I'm a Spartan, and I'm an economist, so I'm triply cursed. Go blue, right? So anyways, and I don't know if you read my bio, but I started out as an insurance economist when I was still in graduate school at Michigan State at the Michigan Insurance Bureau in 1980. That was all before you were born, of course. And then I worked for the Michigan Senate Fiscal Agency, the NEIC, and then I ended up at Georgia State, and then retired at the end of 2018. 2019, my wife and I moved back to Michigan. We now live in East Lansing because we love the winter weather so much with the snow and the ice. So that's just the background on me. Right. So as Frank had indicated, this is basically foundational, and I want to make sure that I leave enough time for the members and the chair to ask questions. So if I could ask you, Madam Chair, is your intention to end at 9 or 9:15? Do you have a deadline?
We would like to allow at least a good 15 minutes for question.
Okay.
And my committee ends at 10:30. So if you can end somewhere around 10, that would be great.
Oh, yeah, we have plenty of time. Yeah, we have plenty of time then.
Okay.
Thanks. Great.
9:45 then?
Yeah, that's right.
Okay,
That's good.
there we go.
That's good. Thank you. Okay. So this is the list of topics generally in the slides, and I'm not going to be able to get into depth on, some of these. I'll touch lightly on some of them. But I do want to leave enough time for Q&A, and obviously the members and the chair can ask me questions about things that they want more elaboration on. So this first slide just talks about risk, and what is risk? Well, economists define it somewhat the same. It's basically the chance of something going wrong and that you lose something of value to you, right? And the objectives of risk management are to reduce risk and reduce the cost of risk, and that's what I come to in this next slide. So we're trying to minimize the cost of risk, and the cost of risk is really what we call in insurance economics the expected loss, but it's also the cost of risk management measures, okay? So we have both of those, and there's a balancing there. Now, in terms of methods, there's risk control, and I list several here, such as avoidance, loss prevention, loss reduction, and then there's what we call risk financing, and that includes things like retaining risk, but it also includes insurance, and that's mainly what I'm going to talk about today is insurance. Insurance is a form of risk transfer. So basically what insurance is, an insurance arrangement, whether it's conducted by, sold by a private insurer or some kind of government entity, is basically an individual or a firm or organization. They pay what is hopefully a small premium that's relatively certain in return for being indemnified against what could be a severe financial loss. And what any insurance entity does, whether it's an insurance company or the government or anything, basically pools exposures. And by pooling a large number of exposures, they can reduce variation, which we in insurance economics call objective risk. And that has tremendous efficiencies associated with it. So I buy most of my insurance coverages from State Farm. So State Farm pools all these risks. I pay a premium for my auto, my home, my umbrella, my boat even, and I'm indemnified against pretty severe financial losses. So that gives me a high level of certainty for which I pay, right? So insurance isn't just about loss indemnification. It's also about providing other services, which insurance agents also do, of course. So that could be loss prevention, loss recovery, what else have I listed here? Risk assessment, all of these things are things that come as a service with insurance. I want to talk a little bit about the pricing of property casualty and health insurance, which in a way is very similar. Basically what an insurance company does, or any insurer, starts with what we call in insurance speak a pure premium, which is really the expected loss costs. So if you think about it, State Farm looks at me buying auto insurance and my wife, and we have it together, and they say, well, what's the expected loss for Bob Klein, on having an accident? And that's really, a function of, it's an actuarial function, right? But they have an estimate in their minds of what I'm going to cost them per year. Now, I may have no accidents, which most years is the case, but like this past year, somebody dumped a chair on the highway as I coming around a curve and I hit it, I had a claim, right? So they have an expected loss for me. So that starts the basis for the premium they charge me. But in addition, and it's based on coverages and a lot of other things, but in addition to that, they have to have a loading for expenses because they have various expenses in issuing and servicing the policy, and then they have to get a profit, some kind of reasonable profit margin. And generally that profit margin, sometimes it's referred to as a fair rate of return, but it's really basically what it should be, what we consider to be the cost of capital for that insurer, okay? If it's higher than that, it's excessive. If it's less than that, it's inadequate. Now, I want to talk a little bit about asymmetric information problems in insurance because these are very important. And because of these problems, this is why insurance is constructed the way it is. Now, adverse selection basically is a tendency for high-risk people to have greater demand for insurance than low-risk people. So if I'm a person who's got a lot of bad health conditions, then I'm going to want health insurance more than someone who's very, very healthy, right? And insurers have to find a way of controlling that because if they don't, what happens to a risk pool is it ultimately collapse. So to give you an example, dental insurance. If you've ever looked at a dental insurance policy or have one, the coverage is very limited. It's like $2,000 and it doesn't cover a lot of things. Well, why is that? Well, the reason is because if it was a lot better coverage or broader coverage, only people with bad teeth would buy it, like me. I have bad teeth, and I would buy a lot more of it. But then it would become prohibitively expensive. So the way insurers combat adverse selection is basically risk-based pricing and underwriting. There's some people that if they don't have to offer them insurance, they won't, okay? Another major information problem is in moral hazard. And that basically is interpreted to mean that if I have insurance, I could be induced to cause a loss to actually get paid, or what's more typically the case, I'm more indifferent to having a loss, okay? And that's probably the more likely situation. So if moral hazard isn't controlled, then your losses are going to be much more, and then the insurance is going to cost so much more. So how do insurers combat that? Well, one way they do it is through having the insureds retain some amount of risk, right? Like your deductible that you pay on your auto insurance, your home insurance, or health insurance. You have certain out-of-pocket payments. But there's certain things they just don't insure, or again, they put very tight limits on. Now, I want to talk briefly about the principle of indemnification because it relates to moral hazard. The principle is that basically, if I have insurance and I have a loss, my insurer will make me no better than whole, right? They may pay me less than my loss, or they may maybe pay me something equal to my loss, but they won't pay me more than my loss. So if I total my car and it's 10 years old, typically I can't expect my insurer to buy me a new car, right? So this principle is applied in most insurance situations. There are some exceptions, like most homeowners insurance policies has replacement cost on the dwelling. So if a tree falls on my 15-year-old roof, I get a new roof, not a 15-year-old roof. So that's the principle of indemnification. Other information problems in insurance. I want to talk a little bit about this because this helps establish the rationale and the justification for why insurance is regulated. And the information problem that insurance economists focus most on, and I myself have, is the information problem faced by consumers. Because we all know pretty much that many consumers don't necessarily fully understand what their insurance policies provide, right? They have some trouble understanding insurance coverages, and people vary with that. And they may also have a little bit of difficulty shopping for the best policy. Now, I know how to do it And I know a lot of people who know how to shop for insurance, but there might be some people out there that don't. The other potential problem is that if there are unscrupulous companies out there, and I'm not pointing fingers, I'm not saying there's any companies licensed in Michigan that are unscrupulous, but let's say that if there wasn't regulation, right, unscrupulous companies or agents could take advantage of people, right? And so regulation also is designed to prevent that as well, and that's something that I'm sure the Department of Insurance and Financial Services does. So, but also to point out that insurers are also challenged sometimes in understanding what people's risk levels are. You know, they don't have a crystal ball, even though they may have a lot of data. So they also sometimes can, you know, have problems in judging people's risk. And so they're always trying to do better at that, you know. But sometimes, you know, that can also be a problem for them, right? Let's see. So major types of property casualty insurance. So on the personal insurance side, I've listed the 4 major coverages: auto, home, flood, which I don't know if you've talked about, but something we could talk about at a later date, and umbrella coverage. Now, in commercial insurance, we have a much broader set of coverages. So you've got your commercial multi-peril, which is kind of a package policy like homeowners insurance is for individuals, commercial property, commercial auto, workers' compensation, commercial liability, you know, even things like inland, ocean, marine. So there's a very broad array of types of property casualty coverages, both for firms and for individuals. Now, this chart just is the premiums written in 2021 for the major property casualty lines in Michigan. And you'll see at the top, personal auto insurance, by far the top, which is probably $10 billion or a little below that in 2021. Homeowners is a second after that. And then you see the various commercial coverages. So clearly, you know, probably the industry writes roughly about $30 billion of premiums in this state every year. Major types of health insurance. I don't consider myself an expert on health insurance, but I have done some work on it. So you've got major medical, group health, individual, dental insurance, which I've just briefly mentioned, vision, disability income, even long-term care. These are all sort of in that health insurance sphere. And then we have life insurance and annuities, term life, ordinary life, universal life, annuities, of course. And all of these things are generally regulated by the Department of Insurance and Financial Services. Importance of insurance to Michigan's economy. I want to spend some time talking about that because when I explain what insurance does, which helps provide certainty to individuals, firms, other organizations, that's critical for doing business. Because if it wasn't for insurance, many of the activities that individuals engage in and businesses and other organizations engage in would be much more uncertain, difficult to do, and some of these activities would not be undertaken. Simply just, you know, it's almost impossible to conceive of a modern economy without good, efficient insurance markets, okay? So basically, again, by trading a premium, you pay a premium, and in return you receive some degree of uncertainty. As you reduce uncertainty considerably, then that allows you to function as a firm or function as an individual. So the last point here is that the cost of insurance can be prohibitive for certain kinds of activities. So another example, for example, would be trying to think, but there are just certain things that would be so highly risky that even if an insurance product existed for it, they would be so expensive that people just, you know, people wouldn't buy it, right? So so that's also, you know, a point to understand. Contribution of insurance to Michigan's economy. It's more than just the employment in the insurance industry. It's more than just the income earned by people that work in the industry and insurance companies and the taxes they pay. It's really also the value added by all the activities that are enabled by insurance, right? Because, you know, both, whether it be a small firm or a medium-sized firm, larger firms tend to be more self-insured, but they still might buy in excess coverage for certain things. Their activities, their contributions to the economy are enabled by insurance. So when insurance markets work well, that helps the economy to work better. When insurance markets aren't working well, then the economy doesn't do as well. So that's how the two are really tied together. So this is a chart on finance and insurance GDP in Michigan, gross domestic product, value added. It's roughly 6% of Michigan's economy, but that's only value. That's only the contribution of finance and insurance in terms of what economists would define as value added, which is essentially the income earned by firms and individuals in the insurance industry. But as I said before, this measurement does not show the contribution of insurance in terms of further enabling, the economy to prosper. That's not measured in these numbers. But even just by this narrow measurement, you can see that it's a significant part of our economy here in Michigan. So next I want to talk about competition. Each line of insurance in a state simply represents a market for insurance, right? So you have markets for auto insurance, you have markets for home insurance, workers' comp, flood, health, all the different insurance coverages represent a market, right? And for the most part, insurance economists believe that insurance markets, even at the state level, tend to be fairly competitive, right? There are a few exceptions, but tend to be fairly competitive. So as economists, what do we look at when we are trying to judge how competitive a market is? Well, one thing is we look at the structure of the market, right? How many firms are in the market? How concentrated is it? We look at things like, what have I written here? Okay, ease of market entry and exit, right? The easier it is to enter a market, the easier it is to exit, greater is competition. Things like profitability. We want firms to be profitable, but not too profitable, right? Innovation is another thing. And of course, consumer information, I want to point out, also helps markets be more competitive. Consumers are better informed and able to shop around. Now, competition is essential for insurance markets to function efficiently, even with some level of regulation. Now, competition tends to work better when, one, consumers are well informed and they do shop around. There are a large number of firms, and also no one firm or group of firms control the market. And also, as I said before, entry and exit barriers are low. And I see regulation and competition working together, right? We have regulation, and we should have regulation of insurance. And in my mind, that helps sets a level playing field. Because imagine a football game, even a nice friendly game between Michigan State and Michigan, right? Without referees, right? It would be a mess, right? So consequently, I sort of view the insurance regulators in one context as the referees, making sure that people play by the rules, and by playing by the rules, the markets work better, right? And so they make sure people play fairly, and if somebody gets treated unfairly, then the regulator should clamp down on them, right? Now, here is some information on personal auto insurance, which I'm sure all of you have thought about and also buy, right? Just a little bit. And, of course, here's where I indicate my bias. I believe that the market, auto insurance market here is competitive, and I've done some analysis. I've got some figures here. The Herfindahl-Hirschman Index is kind of a long-winded term for a measure of market concentration. The higher that number is, the more concentrated a market. It's something the Department of Justice uses, Federal Trade Commission. And our market in 2021 for auto insurance was just under 1,200 HHI. And that's actually considered to be within the realm of low concentration, indicating a competitive market. Now, I've listed the top 20 and this is 2021. I expect that with recent changes that there are more, and these are insurer groups. So if a group has more than one company, I only treat it as one company because they're all affiliated. So if we were to look at this for 2022 or 2023, I would expect more insurers, more firms to be in the market. But this lists the top 20 insurers in 2021, and as you can see, there's a mix there. There's some large national firms, some regional firms, and some single state carriers. And I see that as another indicator of a healthy market. But then again, I'm biased, right? This is profitability, and I know this is probably something that also may come up in discussion. And this shows figures that have been calculated by the NAIC, and they're estimates of the rate of return on equity or net worth of insurance companies in Michigan for personal automobile insurance. So if you look at the figures for auto total, which is the blue line, right, and the green line is auto liability, that's at about roughly, I think I looked at it, about 6.4% rate of return on equity. And in my view, that's not unreasonable, right? In fact, I don't buy any stock in insurance companies because they don't make enough money. But anyways, again, that's just my opinion, right? And people may have different opinions. So let's get to why and how insurance is regulated. I said because of the information problems. There's some other reasons, but that's a big reason. Another reason, if an insurance company does go insolvent, which is infrequent, but it happens, then it can cause a severe impact for consumers and for an economy. So importantly, I'm sure you know this and understand this, the legislature determines the laws that the regulators enforce, right? They don't create statutes, you do, right? But they're required to enforce those statutes, right? Now, each state has its own insurance commissioner. Here we call it Commissioner or Director Fox, Director, but essentially the same thing. There's an organization called the National Association of Insurance Commissioners, which I used to work for. Every insurance commissioner belongs to that organization, and that organization helps provide services for the commissioners to undertake their activities. Major elements of insurance regulation include rates, products, which are policy forms, another way to look at it, and what I call market conduct, or what we call market conduct, which I'll explain in a moment. I want to talk a little bit about rate regulation. Now, every state, just about every state, has a statute, including Michigan, which says that rates must not be excessive, they must not be inadequate, and they must not be unfairly discriminatory. And the regulators here in Michigan and in other states are required to enforce those statutes to make sure that that's the case, right? Now, states use different types of what we call rate regulatory systems to regulate rates. Now, in Michigan, for most property casualty lines, we have something called file and use, right? Now, for auto insurance, when the law was changed in 2019, we went to a system called prior approval, okay? And prior approval, I'll just explain it if you don't already understand it. Prior approval, an insurer has to get approval for its rates before they can be changed and implemented in the market. In file and use, theoretically or technically, they can file and use them, but typically, even in a file and use system, an insurer will not start putting those rates into effect until they've got some assurance from the regulator that they are going to be approved, right? And then there's some other different kinds of systems. So regardless of the type of system, rates are regulated, right? But they may be they can be regulated differently in different states. Some states might be a little tougher on insurers with their rates than other states, right? So that can happen. I've done some research on that. But essentially, if the regulators determine that the rates do not meet statutory requirements, then a filing can be disapproved, or even if they're not satisfied with the analysis underlying the rates, they may send the filing back to an insurer and require that analysis and that to be supported. So basically, it can turn out to be a bargaining process between the regulator and the insurance company over what the insurance company will be allowed to charge. Just coming a little close to my time in, so I'm going to try to finish up here. Solvency. Okay, thank you. Solvency and market conduct regulations. Solvency regulation is very important. Insurance companies are subject to a number of financial standards, which are essentially set by law, but also some by regulation. And regulators do a large number of things to regulate insurance companies. They're subject to extensive financial reporting requirements. The insurance departments all have financial analysts who analyze all that information. The regulators conduct examinations either periodically, at least periodically every 3 to 5 years, and they also can do targeted examinations if they're concerned about something or problems arise. They've got early warning systems. If a company gets into financial difficulty, the regulators have the authority to take over the company and try to rehabilitate it, or if they can't, they'll liquidate it. And there's also state guarantee funds for both property, casualty, and life, so that if your insurance company becomes insolvent, at least a certain amount of your claims, or if you have a life insurance policy, your cash values will be covered by that guarantee association. There's also regulation of what, as I said before, products, so insurance policy forms, particularly for individuals and small businesses, have to be approved before they can be put into place. Market conduct, so for example, a company's marketing activities, its underwriting activities, its claim activities, all are subject to regulation. And if a company, and the way the regulators typically regulate that is they'll review consumer complaints. They also conduct market conduct exams of companies to make sure that the companies are complying with the law and regulations. So key developments in insurance. So this is where I kind of finish up. The risk environment is continuing to evolve. Some risks are getting better, some risks are getting worse. To give you an example, as weather becomes more volatile, whether you believe in global warming or not, the weather's becoming more volatile. And that's really a problem in places like Florida, as you probably have heard, right? Here, not as much of a problem, but still a problem. We're seeing more extreme weather events, more flooding, more tornadoes, severe storms in some areas. So that aspect of homeowners or property insurance is becoming more of a problem. We're also seeing an increase in the frequency of auto accidents, and including severe accidents. And there are a couple of reasons for that. One is that after the pandemic and things are kind of returning back to normal, people are driving more. So if people drive more, you're going to have more accidents. But also there's evidence that people are driving more aggressively. And that kind of originated during the pandemic, but even as the pandemic has subsided, people are still driving more aggressively. And you probably know that from your own personal experience, so I'm not telling you anything you don't know. Now, cars are becoming safer, as we know. They have better safety features. Most of them have airbags now, if it's on an old car. But that makes them also much more expensive to repair, so those costs are going up. Insurers are continuing to explore how to better use data to try to better price and assess risk. And for competitive reasons, they have to do that, because if an insurer's competitor does a better job than they do, then they're going to end up losing if they don't do a good job themselves. Now, we also have technological innovation, and that has some promise to it. As I mentioned before, cars are becoming safer, right? And there are already driverless cars that have been developed and are at least in testing stages, and we'll see more of these features over time, and they have the potential to reduce the number of accidents and their severity. So that's a good thing, although, again, it'll be a little more costly to repair them. Medical technology. As we know, medical technology is getting better, and I experienced that this past year when I've had a bad bout with cancer. That's a great thing. You know, I wouldn't be here if it wasn't for medical technology. But it's also the case that as medical technology gets better, it also costs of medical care get higher too. So that's kind of the other side of that, and something we have to keep in mind. So that pretty much wraps up my talk. I just have a couple other, this is just a thing on fatal accidents, increasing just a chart for you. I've just listed some resources here, some websites, the Griffith Foundation and some others. Of course, the Department of Insurance and Financial Services here. And I've also listed some books. You know, now a couple of those are really boring. The first two and that one by Klein is really boring, but the third book on there, Risky Business, you actually can get an Audible version of that, and it's written by some really high-level economists, and it's really not too bad. I mean, even for normal people. So that's something you might want to think about, and that's just the contact information, Frank's information and mine, and I just live down the street in East Lansing, so I'm happy to come back anytime to talk to any of you, privately, publicly, whatever. Thank you very much. Thank you.
Thank you so much for your presentation. And as you went through it, a lot of things I was able to identify with, like moral hazards and adverse reactions in insurance. But right now, I'm going to open it up to the committee, and we have several people already they have questions for you. So starting with Representative Fitzgerald.
Good morning, gentlemen. Thank you so much for being here today and your testimony. I just wanted to bring back the attention to this slide here with regard to volume of premium sold.
Right.
And I think that for anyone tuning in or anyone in Michigan who saw this slide, they would see that, yeah, at the top of this list is private auto. And they would say, boy, that's a really big line. And they would relate to that. Based on this graph here, it outweighs the next 3 lines of insurance combined. Michiganders have felt that in their pocketbooks and in their policies for decades. And the law of large numbers and understanding, severity, frequency, occurrence, I want a little bit more explanation on this, because if you look at the cost of a homeowner's policy versus that of an auto policy, you might say, well, they're relatively the same, but also the volume of the products written. I don't know if, if there would be data about that of per policy or per hazard that is actually being insured. I think we would see that decrease somewhat, but I'd just like for maybe you to go one layer deeper on that and kind of explain why that does look so severe.
I mean, the auto insurance being much bigger
Correct.
than the home insurance. Well,
all other insurance lines.
all other insurance, right. Well, we probably have roughly 3 million registered vehicles in the state, right? And the premium that's paid for any particular vehicle can vary greatly on a number of factors, which I'm sure you know. And so I would say that one reason why we see so much more premiums written for auto insurance than we see for the other lines is just because it's a very large market in terms of the number of insured vehicles. But I will also admit to you that even with the law changes that were made, auto insurance is still very expensive in Michigan. Various comparisons been done, but we in 2019, I think we were deemed to have the highest rates. Now we have about the 4th highest rates. We're still very high. But again, people make a lot of choices. So the amount of PIP coverage they choose, or they opt out entirely, whether they buy physical damage coverage. So there can be a lot of variation. So I don't know if I'm answering your question, but there are reasons why we pay, we have that amount of premiums in Michigan. Homes, there are a significant number of homes that are owned, right? And people pay insurance on that. Typically, my homeowner's insurance premium is less than my auto insurance premium, but again, that could vary depending on the individual.
And just as a follow-up as well, the other thing too is the cost of vehicles is increasing. I know that a headlamp assembly for a various vehicle right now could be a $1,200 assembly, and so that front-end damage all of a sudden compounds, and there's a great deal of delay as well in the supply chain at the moment, and that increases premiums as well. So just understanding that, and I appreciate the additional explanation.
Yes.
Thank you so much. And next we have Rep. Rogers.
Thank you, Chair. I think one of the statements made was whether you believe in global warming, and I'll just say I believe in the science of climate change. But anyways, I was wondering if you could explain what you mean by a competitive market. The numbers that I've seen lately are that we moved from number 1 highest in the country on auto insurance rates to number 2. So I'm curious what data you're looking at for number 4, but what do you mean by we're still considered in a competitive market, if you could explain that?
Okay, well, I'll try to address both questions. Just on the rate comparisons, it just depends on how you do the comparison. I've used the ones that typically other people have used. But you can compare rates based on a hypothetical policy, a hypothetical driver across different states. But depending on how you construct the hypothetical, you could get different results. So I've seen people who have said that we still are at number 1 or number 2 using one chart, but I've seen other sources who have said we're around number 4. Now, another way to do it is, and I've done both in a report that I've written, is simply taking the amount of premiums that are written, right, and dividing into that the number of insured cars. So that's what people on average spend for auto insurance, and that's something that the NAIC puts out as a report. And based on that measure, we're still high, but not necessarily the highest, right? So to try to answer that question, depending on how you do the comparison, you'll get different results, okay? Did you want to?
No, thank you. Yeah, the data I'm looking at is not on hypotheticals. It's based on real data from Michiganders. So.
Okay, all right. Well, maybe we can talk
Sure,
afterwards
thank you.
about that, and we can share. On the thing about competition, the reason I believe Michigan's market's competitive is because of the different indicators that economists typically use and what I've looked at. So market concentration fits within the low category as defined by Department of Justice and the Federal Trade Commission. I see a relatively large number of insurers, even if you define them at the group level. Profitability is not excessive by generally economist standards. Now, does that mean that everybody is paying the lowest possible price they could for car insurance? No. I'm sure there are consumers out there that could do better than they're currently doing. And that's something, we need to look at and focus on. So no one would say that the market is as competitive as it could be. The question is it what we call in economics workably competitive? Would it benefit from greater regulation? I'm sort of in the camp that believes that our auto insurance market is workably competitive, but I know that there are other people that would disagree with that. So I understand, the question and the different points of view.
Thank you. Next, we have Rep. Harris.
Thank you, Madam Chair. Thank you guys for being here. It's it's obvious you have a lot of background and knowledge. So, I know my other colleague brought up the slide, so I'll go back to the slide again.
Right.
How does this? I know you've said that you believe Michigan ranks about number 4, depending on the variables that get used. How does this slide compare to other states as far as kind of the rankings of these different insurances? Is it a similar view when you look at other states?
I haven't done that. I would expect it would, probably for most states. A state like New York might be a little different, but states like Michigan should be very similar in terms of that. Now, I looked at auto insurance, say, for Ohio, which does not have a no-fault law, right, no-fault system. So premiums are the total amount of premiums written there are somewhat lower, right, for auto insurance. But that's a function of the type of system that we have. But yeah, I would expect something similar for other states, yes.
Thank you.
Rep. Aragona.
Thank you, Madam Chair, and thank you guys for being here. First of all, very important, I want to say, go green.
Yes, right.
Okay. Second, obviously here in Michigan we have a lot of coastline. I used to work in a municipality that had a lot of lakefront homes, right? And the flood insurance that you had mentioned very early on in the presentation was an issue, and especially with FEMA kind of redoing their structure of how they address their rates. Right. And it almost seemed like FEMA was trying to, and by the way, this Insurance 101, I used to be an insurance agent. I used to sell for State Farm, so it seemed like it was almost like a study guide of the tests that I had to take through Lara, so thank you for this. But it almost seemed like FEMA was trying to overcome that adverse selection where you have these homes on the ocean that could get completely washed out and you need to cover that peril, whereas we in Harrison Township, yeah, maybe we might flood every 30 years. However, there's no way you're going to get a tidal wave off of Lake St. Clair that wipes out a house. So can you speak to that a little bit? And is there anything as policymakers that we can do? I know I'm kind of asking you some federal questions, but is there anything that we as policymakers here in Michigan can do to help out our coastline residents?
That's a very good question. It just happens coincidentally. I've done a lot of work on flood insurance. In fact, I've done some presentations to congressional staff on flood insurance with Frank and the Griffith Foundation. Let me say this. You know, a lot of flood insurance is still underwritten by the National Flood Insurance Program, which is part of FEMA, right? But there is more and more insurance being underwritten by private carriers. Now, I have not looked at that specifically in Michigan to see what the extent of that is. But FEMA recently, well, within the last few years, as you
Dr.
indicated,
Klein, can you please speak into your mic?
Oh, I'm sorry.
Thank you so much.
Have gone to what they call Risk Rating 2.0, and that's the system I think you're referring to. And it's tended to be a more accurate system for rating flood risk, right, and pricing it. But it has caused quite a bit of controversy. And people in some places, particularly places that are very flood prone, are not very happy with it. So as policymakers, this might be a discussion, I mean, I'm happy to participate, but it might be a discussion you would have with the Department of Insurance and Financial Services, because they regulate the private flood insurers, and we can get some more information on that. But the private flood insurers can offer a competitive alternative to FEMA. So if you think that the NFIP is overpricing you, maybe you can obtain a lower price policy from a private carrier. But again, everybody's very careful in this space, and it partly depends on the assessment of risk. Also depends on, you know, other things like the cost of reinsurance and things like that. So I'm not really sure I've answered your question. I think it's a very good question. It may be one that warrants its own special time to explore in greater detail.
Thank you. Yeah, I appreciate it. If you do have more information on that, I'd love to take it, because it almost seems like our residents are being forced to cover a risk that will never happen.
Mm-hmm. I will respond to that.
Okay.
Yeah, the thing about flood risk is that in some places it is increasing. I'm not necessarily saying that's in Michigan, although I think there are a couple of counties in the upper UP, the Upper Peninsula, that recently have had some flooding. What we're finding is that there are some areas where previously had not been considered to be high risk, have become high risk. So the pricing will eventually adjust for that. In the meantime, there are also cases where people do not have flood insurance because they're not required to purchase it, and then they end up getting flooded. So this is it's a changing situation in terms of risk. So there are, as you point out, pricing issues, but there are also issues about whether people who have significant risk are buying the coverage when maybe they're not. So those are all things that definitely would deserve some more discussion.
So that sounds like a round two. Okay.
Yes, right.
We have Rep. Green.
Thank you. Go Green.
Yes.
I'm wondering if, in looking at other states, you might be able to give me a little bit of guidance here. Mm-hmm. Insurance is incredibly complicated. Mm-hmm. Your average layperson is obviously not going to read all the boilerplate language, and now we have a law where I think every time where something changes remotely with your insurance policy, you get another packet in the mail that, again, has a ton of boilerplate language. Nobody's picking up on that. Mm-hmm. And what I'm finding in speaking to my friends in the legal field is that insurance policies for people are being retroactively voided for what it seems like almost an innocuous reason. And just as an example, somebody gets into a car accident, they go to file their claim, and then their carrier says, "You didn't tell us your son moved home from college." And so because of that, their premium should have altered slightly, but instead they are retroactively voiding the policy and not paying the claim. And they technically have failed to advise their insurance company of their son moving home because they probably just didn't think of it because who does?
Right.
So it's a technical violation of the policy, but yet it seems like an egregious overreaction and completely unfair to the consumer. I'm wondering, are you aware of any policies in other states that might help people here in Michigan to avoid such horrible incidents?
Right. Well, that's a very good question, and to be honest with you, I'm not prepared to give you an answer on that. I think that what you're raising is this issue about these are insurance policies, an insurance contract, and insurers, legally can hold people to the letter of the contract. But as you point out, most people don't read their insurance policies, and it's not intentional. They weren't. The story that you told isn't somebody trying to cheat the insurance company. It's just something they didn't think about. So the products are regulated by the insurance regulators, so the Department of Financial Services. But I think they would be better positioned to respond to your question. Well, I can do some research on other states, what other states do. But as a general point, I think this is where I think the regulators probably do have to get a bit involved in how insurance companies are interpreting their contracts, because ultimately the contracts are approved by the insurance department. But there also has to be a sense of fairness, too, from a market conduct standpoint. And that might be something that not only can be addressed by the regulators, but working with the industry, say, can we do something here so that type of situation that you described doesn't occur? But I can do some research on that.
I would love to know what other states are doing because, again, it seems like an overreach.
Yes.
And to me, the fair solution would be to say, you should have done this. Now we have to charge you for the difference in the premium.
Right.
That would be, I think, a more fair standard. But unfortunately, they are just going by the four corners, if you will, and in that contract interpretation. So if you could get back to me, I'd appreciate it.
Yeah, I think it's something that certainly bears looking into, yes.
Thank you.
Before we move on, I just have a quick question. Would that be a material misrepresentation?
I'm
Where
sorry?
she's talking about a material misrepresentation?
A material
Misrepresentation.
Yeah, I'm not in a position to really
Okay.
comment on that. Yeah,
Okay.
I mean, the kind of things that come to mind for me is like on a life insurance policy, if they've said, well, have you ever had cancer? You know you've had cancer. You say
Yeah,
no.
that's
That's clearly,
that's
but that's
concealment.
not what she was talking about.
Okay.
Right.
Okay, Rep. Stone.
Thank you, Madam Chair. I'm one of the lay people that Rep. Breen was referring to that is now tasked with regulating and creating policy. And I have some questions. On slide 27, there was the reference to insurance rates must not be excessive, inadequate, or unfairly discriminatory. So when I took office in 2019 in preparation for the no-fault insurance reform, we were given some auto insurance 101s. And one of the things that glaringly jumped out at me was some comparisons of potential driving profiles. So there's many factors that are considered by insurance providers in establishing your rates. And one of them was a woman with a variety of factors to a man with DWI, driving while intoxicated, on their driving record. We're paying comparable amounts. Is there a pink tax in insurance? Is there factors that support that? Is there any way, so we know that rating formulas are largely considered proprietary, and so there's a lack of transparency to that. How are these assessed? How are these rating factors assessed for being excessive or unfairly discriminatory?
Well, regardless of the type of system, of course, for auto insurance, we now have prior approval. The insurers, all of those rate filings, they have to be made. They're public. There should be extensive information that's available also to the public, but they can be somewhat complicated to review, right? So companies are obviously restricted in the factors they can use, but as far as I'm not sure. There's some states that don't allow you to price based on gender, but I can't recall whether Michigan is one of those states or not. we can't can't price on gender
Yes.
technically. So why, this woman or hypothetical woman is paying the same as the hypothetical man? I can't say. The statistics suggest, although this has changed over time, that women tend to be better drivers than men, whether you believe that or not, but it has to be statistically the case. But, but as in Michigan and some other states, you can't rate based on gender.
Well, and there were many factors. There was income, education, geographic areas. And so that also brings into question how those are
Yes.
being rated,
Right.
and the discriminatory nature of those. Because I think many of my constituents and many people across Michigan, even though we attempted to regulate and reform no fault, and as you pointed out, well, there may have been a modicum of improvement, don't feel that in their pocketbook.
Okay. Yeah, well, that's certainly something we could look at. Just so you know, Michigan now prohibits more rating factors than any other state. That doesn't mean we've got it quite right or wrong. It just means that we do. But yeah, there certainly is still a lot of variation depending on who you are, where you live, and other things. And, that's something certainly that could be looked at.
Well, and I would just say, for many of us who were part of that decision-making back in 2019, some
Right.
of those rating factors were more semantic than actual impact.
Right. Yeah. But one thing I would also point out too is that what we're seeing, and if I didn't say this before, I meant to say it, is that what we're seeing is auto rates going up nationally in every state, basically, and that's because people are driving more, they're driving more aggressively, and also cars are getting more expensive to repair. So those factors are coming at us at the same time that whatever effects that the no-fault changes have done are working too. So, yeah.
Thank you. We have a few more questions. This is really good. We may have to do a round two if you don't mind. I know you flew in, but I mean, you flew in, but that's good. Rep. Fitzgerald, you have a comment?
Just a comment, no question, and if there is a part two, this is something that could be addressed then. One of those things that you mentioned is where you live, and part of that is also something that I might ask you to add to your developments in insurance, which is social inflation and the impact of judicial judgments and the impact that judgments are having in claim situations that are impacting ratio, P&E. That is just something that I think everyone on this committee should be aware of. I know IIII.org has an article about this and its impact, but I know that in Michigan, that is something that is attributing to that rate increase.
Thank you.
Thank you, Rep. Fitzgerald. Rep. Harris.
Thank you again, Madam Chair. Just a question popped in my head. So let's talk about profitability. So how does Michigan compare in profits with auto insurance as compared to across the country? Are we in the ballpark or?
Yeah, I've done some analysis of that. I don't have those figures in my head right now. I would say that probably we're not above other states. We might be roughly, if you took a national average, we're right there or below it. As I mentioned, I think auto insurance total, I'd have to look at that chart again, is about 6.4% rate of return on equity. That's not real high, to be honest with you. Now, there may be other ways to measure it, and that doesn't mean that for any given carrier. There's some carriers that are doing better than that. Some are doing worse, and the more recent figures might indicate something else. But I would say that probably Michigan is not viewed as being high from a profitability standpoint. Like if you look at the loss ratio, for example, for no fault in 2021, just the pure loss ratio, that's just losses divided by premiums, it was over 80%, which is pretty high. So I would say, again, that's just my opinion, that our profitability for auto insurance is not excessive here in Michigan, but that's my opinion.
Thank you.
Thank you. I have two questions I want to ask, because when the auto no-fault law was passed in 2020, they eliminated a lot of the discriminatory factors, but they left one in place. Could you tell me what is the difference between zip code and territory.
Oh, okay. Well, insurance companies construct rating territories that consist of a number of zip codes, right? And so they're like a standard set of rating territories that advisory statistical organizations use. But then each insurance company has its own set of rating territories, and it might adopt kind of the standard set or have its own set. So I don't know specifically, for example, MyInsure, what State Farm does, but I'm sure they have a rating territory for Detroit. And they may have several rating territories in Detroit. I don't know for sure, right? And then they have one for East Lansing, where I live, and other parts of the state. So so to answer your questions, Representative Carter, it's the zip codes are probably, for the most part, just put together to create a rating territory.
And see, that was what I was thinking, because my insurance rates increased when the territory was put in versus the zip code where I live.
Right.
Okay, so I just wanted to make that comment. And then my final question, I'll ask, can you describe what a loss ratio is and how it pertains to insurance, how you determine whether or not a insurance company is risking solvency?
Right.
Insolvency?
Sure. So the loss ratio is just the pure losses. There's something called a pure loss ratio, which is just the losses they pay out. Or it's on an incurred basis where they includes estimates for what they're going to have to pay in the future, right? And you divide that by the premiums that they earn for a given year or set of policies. That's a pure loss ratio. Now, you can adjust that loss ratio for what we call allocated loss adjustment expense. The expenses involved specifically in adjusting a claim, and that's a little bigger loss ratio, right? But then you have all the other expenses that an insurer has, like the unallocated loss adjustment expense. It's general overhead expense, taxes and fees, including premium taxes. All those are loaded on top of the loss ratio. And you get something called the combined ratio, which some of you may have heard of, which is all of those, the losses plus all the expenses, and you divide that by premiums. And if that's above 100%, that's telling you that your profit margin is negative, right? Now, insurers also earn investment income, right? And for some lines that what we say have a long tail, which it may take several years for a claim to get settled or fully paid out, they can earn investment income on the reserves they set. So that for those lines, they don't need quite as much on the margin, right? But either way, a loss ratio is just that. Pure losses divided by premiums, and then you have everything on top of that. So for any specific line of insurance, and even within auto insurance, you have the different coverages. What's reasonable as far as a loss ratio, or what would be considered too low or too high, really depends on, it has to be a specific analysis based on that particular coverage and all the expenses associated with that particular line. Yes.
Thank you. We're getting close to the end. Colleagues, do you have any additional questions, anyone? Well, this has been extremely informative. I really appreciate you coming in to give the presentation. I would love to have you both back, as we go deeper into this session, but I think it was very value added for you coming in, and we are all very appreciative. So thank you very much.
Thank you. Mm-hmm.
Okay, so where are we? Well, I don't see any absent members. All members were here today. So, seeing that there's no more business before the committee, I need a motion to adjourn. And Representative Harris gives that motion to adjourn. Hearing no objections, this committee is adjourned. Thank you.